Good morning, Josephine. This is Wanlin. After we finish your tax return, I also have some questions and issues want to talk with you. First of all, your husband Pacey will not pay any tax due this year, and the tax refund she will have is the $54,690. And the second question asked me about Schedule A. And for the medical and dental expenses, which is the first column of the Schedule A, we add the medical expense the Pacey provided to us and minus the medical expense reimbursement, which is provided by your employer, because it will be beneficial for both you and your husband. And for the second column, which is taxes you paid, we add up the state and local taxes of the first 3 quarters of this year, and take out the state and local taxes of last quarter in prior year. And the interest you paid on the home mortgage is basically similar with last year. And we also put charitable contribution on Schedule A, and I will provide the explanation in the later of this video. And we also deduct the tax preparation fees, which is $2,900, which is provided by a Pacey. After the income limitation, Pacey can get 77 deduction for this tax preparation fees. And we also deduct the whole amount of gambling loss because it's lower than your gambling winning. After addressing the itemized deduction schedule, I want to talk about Schedule C. The reason it's different from the book income statement Pacey provided to us is because based on the book income statement he provided to us, it includes the charitable contribution as business expense and the rental revenue in the other income column. However, this charitable contribution is not for business purpose. It's completely for charity, so we can only deduct the charitable contribution on Schedule A as from AGI deduction. However, I will suggest Pacey next year if he want to donate cash or gifts to charity, he can use this charitable contribution for business purpose such as advertising, and we can deduct. And in this way, we can deduct this charitable contribution as business purpose on Schedule C. And for the rental revenue, we also remove this $9,600 from the income statement you provided to us, and change it to Schedule E because it's for rental property. Compared with the Schedule C from prior year, Pacey have a much lower net profit on Schedule C, which is only $283, and this will reduce his AGI to a really small amount. So this big change is mainly because of the depreciation expense and the Section 79 expense. So here is a big suggestions and tips for you and your husband or any other small business. Small business owners. The Section 79 expenses is really important because it allows us to take immediate deduction from the capital assets. So it's better for every business owner to take advantage of this Section 79 expense. The other thing I want to address with the depreciation expense is the method we use to calculate depreciation expense. First of all, the income limit we use to calculate depreciation is the net profit on Schedule C without any depreciation. And for the Section 79 And for the method we use to calculate depreciation expense, we stick to the long to short and high to low rule to choose 500,000 new furniture as our 79 property. And 79 expense, so we took 79 expense of $362,000 from the old furniture. So the remaining basis of the assets purchased in the fourth quarter has been already 69% of the remaining basis of total assets we purchased in current year. So it forces us to change the conversion method to mid-quarter after we take out the 79 expenses. For Pacey, he can also choose to max out the fourth quarter assets and continuously use the half-year convention without messing up his conversion method or calculation. However, if he chooses to do so, the net profit on the Schedule C will probably larger than using the mid-quarter method. Actually, here are different combination of 79 expenses you can deduct from your assets. For example, instead of taking out the 369,000 from the new furniture, you can also take out $53,000 from new cooking equipment and $300,000 from new furniture. So this will bring your net profit on Schedule C to even lower amount. However, based on the fact that we already bring the tax due to zero, so I think we already take the maximum benefit from 79 expense. The other big shift from prior year's tax return is the education credit. This year, Pacey is qualified for education credit, and he has two choices to file the tuition fees, which is on Form 8970, and he can also choose to file the American Opportunity Credit, which is the education credit. However, we choose the latter one because if Pacey chooses to file the tuition fees, he will only get 2,000 tuition as a 4H deduction. So that means this $2,000 will subject to tax rate when we calculate final tax. So Pacey cannot take advantage of this whole $2,000. I think it's even less than $1,900 because of the tax rate. And if we file Form 8863, which is the education credit, Pacey will get 1,909 education credit, and it will reduce his tax dollar for dollar. So based on the fact that the education credit can generate more benefit, we choose to claim the American Opportunity Credit. And by the way, the tax rate the tax bracket you subject to is the 25%, which is the top column of tax brackets. Okay, so the last thing I want to talk about is the expectation for next year's tax return. Based on this year's return, I expect next year's return will be closer to this year instead of 2014 tax return. Because of the depreciation expense, I think Pacey will still purchase even more new equipment and furnitures, and we can take the maximum benefit from 79 expense and the depreciation expense. And for this year, Pacey have a gain from the casualty and theft accident, which is the fire. Thanks to the large amount of insurance reimbursement, the $40,000 reimbursement covered the whole adjusted basis of the old furniture. So, however, for next if next year the same accident happened, I think Pacey will generate loss for the accident because he purchased a lot of new assets in this year, and probably the reimbursement next year cannot cover the original basis of the new assets. And the very last thing I want to talk about is the scale of the Pacey's company. Right now, the Pacey's company's size is not large enough to provide insurance coverage to his employees. However, based on the fact that he has moved to a new building, so probably he will hire even more employees. So maybe next year he need to provide insurance coverage for his employees, or otherwise he will subject to penalties. And so here is the things he can do for this year. If he need to provide to provide insurance for his employees, he need to find ways to fit these costs into his budgets, and he must also figure out how much the premiums it will cost, and decide how much of that cost will pass on to his employees. So this is the question and issues he need to consider for next year's return. And I'm also considering the timing strategy to accelerate your deduction and defer your revenue, because the individual federal tax rate will be scheduled to be the same for 2016 as 2015. So deferring revenue into 2016 while accelerating deductible expenses into 2015 will make sense for Pacey. The other things I will suggest you is about your Social Security tax. Based on the fact that you are not executive officer in your company, so it will not provide Social Security tax on your behalf. However, if next year or in the future you get a promotion, you probably need to add the Social Security tax to your wages, and so that means you will be taxed on your Social Security tax, which is paid by your employer. But you don't need to worry for this year because your income is below than the Social Security limitation. So your Social Security wages and your wages are basically the same amount. Okay, so this is the suggestions and answers I can generate for your questions. Thank you so much. Thank you for watching the video.